Welcome back to your ACCA F8 Audit and Assurance trainee videos. Your next session is going to deal with the audit letters. It is a combination of the sections of the syllabus, generally dealing with letters that are issued or signed by the auditors towards the client company. And this is just because candidates usually make a mixture of them. They don't recognize immediately what the examiner wishes from them to write about. So there are three main types of letters we are going to discuss: engagement letter, management letter, and management representation letter. In the exam, it's quite unlikely that you are going to be asked to reproduce these letters in full, so you don't have to write the letter, but you might be required to explain parts of a letter or to reproduce parts of it, for example, of a management letter, in case of internal control deficiencies that were identified during the audit. So let's see what you also need to take here into considerations. Obviously, besides these three letters, there are some other communications issued by the auditor and circularized to different third parties like banks, customers, suppliers, selling agents, consignees, and legal representatives. All these letters basically would represent audit evidence throughout the audit process. If you would want to include them in one of these categories, it would be the management representation letter, because that is one kind of audit evidence. So related to this, we have further more letters to discuss. But these letters are plain and simple. You know, whenever we send a letter to the bank, that's a confirmation letter, and all the other third parties as well. The engagement letter. What is the engagement letter? It is just basically a contract between the company and the auditor. And what it aids to is to avoid future misunderstandings. So we know exactly what is the obligation of the auditor, what is the obligation of the client. When the engagement letter is issued, it is usually issued once at the beginning of the audit engagement. It is not required to be issued or reissued on a yearly basis. It can be maintained if there is no significant changes in the scope or the context of the audit. For example, if there is a consolidated company, there's a new subsidiary that was bought throughout the year, then the audit scope will be extended. Or if there are significant changes in the client's management, that again will require the engagement letter to be reissued. However, auditors in practice do frequently send out the engagement letter on a yearly basis or an engagement basis, just to remind the entity what are the existing terms of the audit engagement. What you should know for the exam, besides what is an engagement letter, is what the engagement letter would include, and this is something that you should learn. Yeah, we have the audit objective of the audit, is the auditing the financial statements of the client. What are the management responsibilities? That would be, for example, preparing the financial statements. Relevant legislation and relevant professional standards. What is the legislation based on which the financial statements shall be prepared, and what is the legislation according to which the auditor performs its tasks. Professional standards according to which the auditor is going to perform his task, for example, the code of conduct. Audit procedures that are going to be carried out. This usually refers, and it's usually mentioned, that it is based on a sampling test. Audit provides a reasonable assurance that is based on sampling. It's not a full audit. Then the other aspects like liaison with the internal audit department, use of other external experts, risk assessment, the auditor's access rights, so that he has unlimited access to the company's information and files, client communications, what are the deadlines, up until when the report shall be issued, what is the format of the report, how it's going to be billed, what happens if there's overtime, overwork, that's the fee basis, what are the dispute settlement procedures, what is something going wrong, what is the relevant legislation, and requests for confirmation that the letter was actually received by the client. Please have a look at the format or a template of an audit report of an engagement letter as per ISA 210, agreeing the terms of audit engagements. The next letter is the management letter. Now, what is the management letter and when it is issued? This is a different point of time during the audit process. When it should be issued, that is usually consent between the two parties in the engagement letter. But it's usually it is done at the end, towards the end of the audit, when the auditor already concludes about the internal control system of the client. The reporting, basically what the management letter is reporting to those charged with governance, it is related to ISA 265, communicating deficiencies in internal control to those charged with governance and management. And what we are doing here is that we are reporting the weaknesses that we have identified in the company's internal control systems. They can be either inherent weaknesses when we were assessing the client's control systems, or weaknesses that were identified during the tests of controls and show the auditor that the system is not working as it should or as it was described by the management. It's usually produced on an annual basis towards the end of the audit, and as content it usually includes deficiencies, consequences of the deficiency, and what is the recommendation of the auditor, how the client should solve those deficiencies, how it should work out. This would be also, let's say, the best way in the exam how to tackle such questions. On these three headings: deficiency, describe clearly what is the deficiency that you identified in the internal control system. Then what is the consequence? Consequence would be, so material weakness, the consequence. What is the consequence? Let's say you shall estimate what would happen if these deficiencies are not corrected. Loss of profits, misappropriation of assets or stolen assets, whatever extra costs that will occur. And then there should be a recommendation from the auditor to eliminate these weaknesses. This must deal with the specific deficiency on an individual basis, and you should also provide some benefits. What would be the benefits? That would be some kind of the opposite of the consequence. What would be the benefits if this deficiency is corrected? You can also use a tabular format in the exam to represent these three issues: deficiency, consequence, and recommendation. You might meet this in the exam. Written management representations. What are these? These are guided or by ISA 580 written representations. They have a twofold purpose, basically to obtain representation from those charged with governance that they have fulfilled their responsibility in terms of preparing the financial statements, obviously according to relevant financial reporting framework, and then providing the auditor with all the relevant information and access to financial records, and recording all transactions and reflecting them in the financial statements. On the other hand, written representations from management can serve the auditor to support other audit evidence relevant to the financial statements if determined necessary by the auditor or required by the standards. So, as I said, it's their responsibility to produce financial statements, that they have to provide audit evidence, and then it's obviously a compliance with best practice also. Again, representations, when they are issued, it can be in various stages during the audit, but it should be at least on an annual basis, as close as possible to signing of the audit report. So this is again towards the end of the audit engagement. Content, as I said, the confirmation of the director's responsibilities regarding the preparation of financial statements, that they have provided all the information to the auditor, if they have to provide some facts which are confined to management, and about estimates and judgment that the management used in preparation of the financial statements. Now, how these should be obtained? The auditor, doing its work, usually it confirms issues for which they need to seek for representations from the management side. This must be formally documented and signed and send it back as a response to the auditor. They may take several forms, like a letter from the client to the auditor, or it can also be a letter from the auditor to the management setting out the necessary points, and then the management signs it and sends it back, or just a minute of a meeting where representations were made orally and which then is signed by the management. Please note that the quality and the reliability of the written representations is not the best one, since they are internal source of evidence. They are always subject to bias. As the ISA 580 says, in their own, they do not constitute appropriate evidence. They can support other audit evidence, but in their own, they are not sufficient and appropriate audit evidence. It can be still useful where no other better quality forms of evidence can be obtained by the auditor, but we have to judge their reliability based on inconsistencies, if those can be identified, with other forms of evidence, or looking at the people who are we dealing with, basically the competence, their integrity, their ethical values of the management. Whenever there is an inconsistency identified, the auditor shall perform further audit procedures. If this is not possible, then they should withdraw maybe from the engagement, if that's possible according to laws and legislations, and they should also consider the impact on the audit report. If the management refuses, for example, to provide written representations, the consequences will be probably the same, either disclaiming the audit opinion or withdraw if it's possible. Right, this is what we consider the most relevant points about communications letters written by the auditor. In our next session, we are going to discuss about audit risk.